So what are we going to do today? We're going to talk about something called QBI deduction, which is qualified business income deduction. Now, if you recall, even at the time when we were doing the overview class, I told you the concept behind it. Now, see, what was happening was US was not considered a preferred destination for a lot of corporate houses. The reason being, the corporate tax rate was around 35%. And I'm talking about, I think, 2017. And that was a time when Donald Trump came in with the agenda that he's going to bring all the work in the US and he's going to stop the immigration. And that concept, that political manifesto, got reflected in his policies, majorly the tax policies that got implemented. Now, one of those policies was to reduce the corporate tax rate. Why? Because there were businesses who were going out. As it is, the skilled labor is very costly in the US. And then the tax rates were so high. And if you would combine the corporate and the state taxes, then the net result was a huge chunk of the pie was going to the government. So what happened in the year 2017? So with effect from I think 2018 beginning, they scrapped the corporate tax rate and they brought it down to 21%. And at the same time, what they did, there were concepts like the AMT concepts on corporates that also gradually faded away. So right now, there is no concept of an alternate minimum tax in corporates in the US. In India, we call it VAT, minimum alternate tax. So they have still retained that concept for individuals in the US, but they did away with that concept in the corporates. Now, understand that this 21% is relevant only for separate tax paying entities, which means if I am filing a separate form, which is 1120, if I'm entitled to file a separate form and if I am a separate tax-paying entity, then only I'll get advantage of a 21% or a lower. So I'm talking about a 14% reduction in the tax rate, which is like a humongous amount. So what happened? Now they had to do something in R with not just C corporate form of business. Because if you look at it historically, the major chunk of business anywhere in the world is not just the C corporates, but a lot of those sole proprietors, partnerships, limited liability companies, all in one term, as we call them in the US, flow through entities. Now, what do you mean by flow through entities? It means that there would be two forms. So, yes, if I'm filing a partnership return, there would be a form 1065 or an 1120S or a Schedule C of form 1040, or probably even estates and trust, as you will read. I okay, that's not in your syllabus, but yeah, estate and trust. So all of these became like conduits. What do you mean by conduits? It means that these would actually be a form of business. So let's talk about a simple one. Okay, I think I'll just give you a visual here. Okay, see, this is a rule based topic. Okay, I have to tell you the rules 1, 2, 3, 4, and I'll take you there. But before that, I want you to have some kind of a preface and some kind of an idea of, how do you correlate the rules with some basic concepts. Okay, so what happened was, let's say we have sole proprietorship. So, what is a sole proprietor doing? So let's say A has a sole proprietorship. Okay. So what would A do? A would open a business. And typically, if you like in India, if you look at it, we'll just take a trade license, or let's say, if very optimistic, I'll take a GST number and I'll file a paperwork and I will go ahead and I'll start my business. Now, this actually legally, if you look at it, there's a legal paperwork. So the legal paperwork will say A and A enterprises are two separate legal entities. That means even when the contracts would be signed, they would be signed in A enterprises. But if you look at tax, tax would call you a disregarded entity. It is a disregarded entity. Tax would say, I know that A enterprise exists, but I don't see them. I don't see anybody called A enterprises. So who do I see? I see a sole proprietor. Why? Why is that so? Because at any point of time, A enterprises, I feel, is somebody who can vanish any point of time. Why? A sole proprietor's life is attached to the entity's life. Sole proprietor dies, entity dies. So whom do I fix the liability? I say, okay, the liability goes to the sole proprietor. That means I do have a form. I give you a structure. I call it Schedule C of Form 1040. But then what you have to do is whatever profits you're making out of it, you have to club it in Form 1040. which is the individual taxation form in the US. Now we extended this concept to partnership. So we said, okay, instead of A, now we have A and B. And A and B would go and make a partnership called general partnership. What would the general partners do? Okay, both of them are general partners. Both of them will run a business. When the business goes away, both of them ideally would share profits and losses throughout the year. And when they don't want to do the business will wrap. Always remember, now this is something that you will learn also in another topic called forms of businesses later. And the more difficult it is to enter and exit, the more legal formalities you have, the more tax advantages you get, ideally. Okay, because there's something that has to come to you at the end of the day, at the end of after all of this exercise, right? So the process of formation and the process of liquidation, that also has a bearing on what kind of protection do you get. So what happens with general partners? You would say, okay, I will share the profits and losses. But then again, let's say they formed AB partnership. When they will form AB partnership, partnership will have a return. Why? Because now we have a separate entity. We cannot just put it in A or B. So we say, okay, listen, you put it in A and B, but I still want to know what is a partnership doing. So I will still coax you to form partnership tax return, which is 1065. For all practical purposes, this just helps me correlate and catch you later. So I will call it an information return. And what I will do, let's say partnership, both of you invested $100, partnership took 200, and the 200 grew up to, let's say, 500. So this 500, the couple 300 of profit, I will give 150 to A, 150 to B. And later on, you will see, when we do the partnership taxation, we will say, see, I will tax you at the time when the profit is generated. I don't bother whether you are actually pulling that money out and you're not pulling out. So the day when you earn that money, portion of that will flow to you. So you will see later when you do partnership tax return that there will be a tax return called 1065. And then each of the partners will get something called a Schedule K1 of Form 1065. And each of them will have something called Schedule E, which they will incorporate in their 1040. And the same concept we're going to go for LLC. The same concept you're going to use when you take an S corporation. There the form will change 1120, 1120 S K1, and the K1 will flow into your Schedule E, and that Schedule E will become a form or part of Form 1040. All of these entities, now see, at the end of the day, all of these entities are paying tax in their individual 1040, which means they would still have the highest incidence of tax rate, which is 37% applicable to them. So the government came in and said, okay, I hear you. I know this is not fair. So what I do, I will give you a qualified business income deduction. And what is a qualified business income deduction? See, it's a fancy name for saying whatever money you are going to get from whatever money you're going to earn from what, from your business. So see, you are running, I am a sole proprietor and I can have lots of hats. I can have a service department and I can handle that. I can go and have my own consulting. I can go and teach in colleges. I can be an adjunct faculty or a proper full-time faculty at somebody's place. So I can wear a lot of hats, right? So what I tell you is, see, if you're a sole proprietor, or if you're a partner, or if you're an S Corp member, or if so, you have a flexibility to do a lot of things, not just this thing. So, what I'll tell you is, first, find out what is the amount that you're making out of your core business. So, the word that you should remember is core business income. It has to be your core business income. And secondly, I am interested only if you bring something to me. That means I'm interested in you only if you are within the US. So if you're a business operating in the US and if you're a flow through entity whereby you're forming yourself and organizing yourself as some kind of a business and you're generating money flowing through that money into your 1040, I am ready to give you a deduction called a qualified business income deduction. But mind you, that money has to come from the core business. Now, I know it's a little, that means when I say core business, there would be some passive money like rental, like your dividends, like your interests. I would say, see, all of these, you take it out. I'm not interested in all of this. Now, can somebody think and tell me if you're a sole proprietor, What should ideally, what are the other challenges that might come in? Can anybody think? This is a little far, but if you can think, it will help you later. See, if you are a member, now we have done this, right? Now, see, we have done part one. Part one, we've done a lot of the details about the gross income and the adjustments and the items. Now, we have done gross income. We have done adjustments. We have arrived at AGI or MAGI. Then we have done itemized deduction and standard deduction. Now, all of this has resulted in a particular figure just before the qualified business income deduction. For a sole proprietor, do you guys remember we had one half of self employment taxes? We had health insurance premium deduction. Where was it taken? Can anybody tell me? Where did we take all of that? One half of self employment taxes. We took health insurance premium and we took the sole proprietor's retirement contribution. Do you remember? Very good. So we took it in adjustments, right? Yes, we took it in adjustments. Ideally, all of that also is not business income. Can you understand? It's my contribution to my retirement. So if I'm a sole proprietor, I put in some money, take it out, and I put it for my health insurance, my retirement, my self-employment taxes. So we say first figure out what is your core business income. So if you are a partnership, or if you are a sole proprietor, or if you're a member of an S corp, and if you have all of these so S corp, you would see the self-employment taxes are not applicable, but health insurance would still apply. So understand all of these personal nature expenses, remove it from the core business. So remove the rentals, remove all the passive form of income, remove all of those personal money, which is actually guided or which is also disguised like a core business income. Remove all of that. And then, so basically, there are two kind of adjustments, right? Remove passive, remove personal. Take it out. And then, whatever is left, that I will call it as a QBI. And now, on that QBI, you will get a 20% deduction. So, whatever is a figure, I'll give you a 20% above the line deduction. Now, problem that happened with a sole proprietorship or a partnership or an S corp was there were so many businesses which were actually businesses, but they were doing services. Like, I can have a sole proprietorship. Say today I'm teaching, but the work that I'm doing is essentially in the nature of service. It essentially was in the nature of services. So a lot of people who were in the US working as freelancers, working as a sole proprietor, but at the end of the day, they were kind of employees to their own self. Can you understand this, guys? They were a kind of employees to themselves. So what we said was, okay, I want to segregate the two kinds of businesses. I will first segregate only service business. And then I will segregate not only service business, like others. So what was idea? I'll tell you. The idea was that see, if it is pure service, maybe what you're earning is equivalent to wages. I would not call it core business. Yes, there might be other things, but if it's just a pure functioning, it's just the difference is that you're not working for somebody, you're working for yourself. And here I will put all of those high collar jobs that gives you that ability that you can generate money by purely doing service. So I say, okay, the moment it is service, the way I am going to, so who am I? I am IRS. The moment I only see you doing a professional service, I'm only letting you see and do services. I am going to treat it typically like wages. And then I don't want to help you with a 20% deduction. So you will see that later on, when we talk about only services businesses, they have linked the withdrawal with wages. So I'll slowly try to figure out whether you are goods and actually running a business per se, or is it just a substitute for services that you're giving, not to your somebody else, but to your own self. If it is only purely service and if it has no element of business, as I call it, I will probably treat you more like wages. So I'm going to slow. And remember, we don't just, it's just not one point thing that I just call it this way or that way. I give you a kind of phase in to slowly bring it up to your wages, and then I'm going to withdraw it completely for you because I am not looking at you. You are not my target for introducing this QBI deduction. But if it is not only service, that means you may be somebody who's into something like which is trade. So we have given you some clear concepts of how do you define service, and everything else which is not service, I will call it as others. And there is a fancy name that I will put to this, but this is the concept. This I'm going to charge you, and this will ideally will get eligible for a full 20% deduction. Ideally, this was the base concept. And then company services started coming in, and then I called it a fancy name. What is the fancy name that I called it? I called this specified services, trade, and business. So specified services. And then I said, okay, if you are a lawyer, if you are a CPA, if you're an accountant, if you're a doctor, if you are a sports person, if you are a film star, all of you, what you do is you get only service. But then we said, okay, but then I can be a plumber and I can be a very good plumber. I can be a candle maker and I can sell some best candles in the world. So how do you know that this is only service? And then the IRS came up and said, okay, I am sorry. Let me just put it like this. If you have the power, if you have the power to demand some money, even when you're not doing anything, like let's say you are having some kind of an endorsements, you're having some kind of a public appearance, public show, or let's say just your name is going to bring you some money, something, associate yourself with a celebrity, a sports star, somebody like that, where a lawyer, lawyer's name puts a weightage, a CPA, even if I'm not there, my name, my legacy would continue. For these kind of work, I'm going to call you an only service business. I'm going to slowly phase off your the deduction, link into your wages, then I will one day take it out completely. For the others, I am going to give you a full 20% deduction unless and until I feel that there is an element of the only service business. So, what we've done, we've defined this because the rest, anyways, goes to the other way. So, I called it specified services, trade, and business. And this I say qualified trade and business. Qualified means qualified for getting this deduction. So one is specified and the other is, so if you're not specified, so if you're not somebody whom I have to mark and take it away from you, then you fall in the qualification. So what is important? I need to first understand what is QBI. Okay. So what is my core business income? So first I have to understand, am I eligible for it? So if I'm eligible, only if I'm running a trade or a business in the US and I'm making some money out of that business. If that happens, how do you realize, or what is the income that I have to be considering for this deduction? It's the core income and also the income which is getting only out of performing that business, not out of my health insurance contribution, not out of just passively investing my income and stuff. So, first, am I eligible? Second, what is that QBI that I have to consider? And third comes the biggest question, how much QBI? So here I give you three questions. What are the three questions? Now this, if you can understand all the three questions, then we are sorted. We first need to understand, am I eligible? This is the first thing that I need to understand. Am I eligible to get this deduction? The next question that I need to understand is, what is my QBI? What portion of the figure comes as a QBI? So I need to know, okay, this is my core business. I take away personal, I take away, then I get that amount. So that figure, typically we are going to call it money coming out of your core business. That's the way we are going to deal with it conceptually. And then we need to know how much. Now, the third question becomes how much. Now, when you need to know how much, then the IRS comes up and say, okay, how much will depend upon who you are. Are you into a so are you a Shah Rukh Khan, or are you a Tom Cruise? Who are you? Or are you a player? Are you Virat Kohli? Because in that case, I don't think you need this deduction. And then I need to know how much you earn. So these are the two questions that's very important. Who are you? And second, how much you earn. And this earning, guys, do you think this earning should be core business income or should be total income? What should this earning be? Where do you think I should phase it off for you? Whether you deserve it or not, whether you really need it or not. How do I relate it? Do I relate it to my core business? Do I relate it to my total income? What should I be relating it to? What do you think I should be, if I have to pull back certain adjustments, should I be taking it on the core business income, or should I be pulling it off on the total income that you're earning? How do I determine whether you deserve this income? See, if it is core business, my core business might make money, but if I'm losing money elsewhere, at the end of the day, if my income is not so much, then probably they will not mind giving me a deduction. So what they have told you is that, see, I need to know not just your core business, but think of it from the other way around. Think of it not how much money is the business money. Think, what if the business is not making a lot of money? So my core business, I wanted to, so I was a teacher, then I was a lecturer, I was lecturing, and then I started my own startup, and then I'm running my own professional firm. So I have lots of businesses, and one business here is not making a lot of money. Or let's say I had one business, and then there were other wages that I was drawing, and there was other things that I'm doing. So they are saying, see, it doesn't matter how much money a core business is making. I need to know, are you rich or not? If you are rich, then you don't need this deduction. So don't think about the state when you're making a lot of core business money. Think about a scenario when your core business is less, but your other income is very high. So if your other income is very high, then I don't think you need this deduction, irrespective of how much is your core business making. So this, how much you earn, the parameter that they've used is your taxable income. And what is a taxable income? They call it a taxable income, but it is, you know what? It is gross income minus adjustments. You get your AGI minus your standard deduction or itemized deduction. This figure that you get here just before the deduction, they tell you that income. They say you take this income. If this income, and now I have defined a threshold for you. If this income is very high, I don't think you need this deduction. If this deduction is very low, then you need the full deduction. If you are a SSTB, so now there are two factors on which they have pulled out this deduction. So general rule, if you're running a business, which is a flow through entity, you are entitled to a 20% deduction. Then it kind of phase it out for you. Phase it out for you on two parameters. First, what kind of a business are you running? Are you a QTB or are you an SSTP? And then, so instead of saying who are you, let me just call it what kind of business are you running? I think that will make more sense. What kind of business are you running? Do you deserve this? And second, how big the fish you are. So I take the gross income, I reduce the adjustment, or I arrive at AGI, reduce the itemized deduction, standard deduction. So it's taxable income just before considering the QBI. So these are the two parameters in which I will define how much amount I should bid. So basically, I give you 20 and then I pull it back. So when I pull it back, I will determine that. So again, now see what are the factors that are important. So here, it's difficult to give you all the details. But what we have done is we've given you certain parameters. We've defined the periphery. You cannot exceed beyond this. So I'll tell you the rules. We'll get to it. But the concept, is the concept clear? Now we will go to the roots. How has IRS defined it and stuff like that. Now with that, let's start the session. Okay, so we are going to do a couple of things here. We are going to, so I've already given you the overview, but I'll take you through the slides. This is important. This is rule based, but if you're able to link it with some kind of a concept, the rules becomes easier to digest and to apply efficiently, correctly every time. Now see, topics like this, later on when we are going to do things like kind exchanges, I will first give you the base concept. But then when I ask you to do the questions, initially I want you to do it rule based. Step 1, step 2, step 3, step 4. Step 1, step 2, step 3, step 4. Gradually, you will be able to link the concept with the rules, and that's the time when you will never get it wrong. Okay. Now, these two are not there in many content providers thing, but I think it's not very difficult. So I've just put it, but we'll do it theoretically. Okay, it was there earlier, but I think specifically Becker has curtailed down the QBI discussion. Okay, so I will first teach you what is the basic, and then if we have time, we will layer it. But this is the key deliverable of today's session. So let's take the first concept now. So what is QBI? 1 second. Okay, so what is QBI? So if you look at your form 1040, I think it's a good idea to take the form out. So if you look at your form 1040, Okay, look at this. So this is your second sheet. Look, the first one, I've taken my income, I've taken all my adjustments. So can you see additional income will now flow through from schedule one, and then you have all your adjustments, and then you will take either your standard deduction or your itemized deduction, which will come from schedule A. A quick question: what is the standard deduction for a couple for the year 2023? What is the standard deduction for a couple for the year 2023? It is 13,850 into 2. But this is a figure that I want you to learn. Even though I think they might give it to you in certain sims, but definitely in MCQ, I would want you to learn this figure. So we are going to decode how to put it this. I am not going to show you Form 8995 in details because that's outside the scope of your syllabus. How do we arrive at this figure is what we are learning now. Okay. So as I told you, there's some history that we had it in the before that, and when we clubbed it, we wanted to pass on that benefit to flow through entities also. What is the basic deduction? It is 20% of QPI. So it is not that we've segregated the income and we're taxing at preferential rates. So it is not like LTCG, guys. LTCG, we show the income, but then we take that income out and we charge at preferential rate. This is not the concept. We put everything and then I give you a deduction. I am not charging anything at a preferential rate. Okay. So what is the first question? Who is eligible? You must be a flow through entity, maybe a sole proprietorship, partnership, LLCs, S corps, trust or estates, and the amount of money on which you would be uh, charging this is the business that is carried on S corporations or smaller corporations in the US, something like a private limited company in India. Okay. Then we have these income which is conducted from the business conducted within the US. And very important thing is the income should arise from your core business. The business cannot arise from anything but the business that you're doing. And that amount of money that you're considering, that has to flow through in determining your taxable income. So if there's any reason by which you will not take that amount in your taxable income, then you will not consider the QBI deduction for that amount. Okay, we'll show this, what it means. And the third question that we need to ask ourselves is, how much deduction are you going to get? Are you going to get the deduction? So that depends on two things. What kind of business are you going to get and how rich you are? How do you define how rich you are? That will depend on your definition of taxable income. What is a taxable income? That's the income arrived at just before taking these deductions in question. Okay? So three things. Who's eligible? On what income? How much? Now, as I told you already, there are certain income that you're going to take outside. Now see, as I told you, two things. If you are not including anything in determining your taxable income, you are not going to include it later. So if you are removing something, this is not something that I can explain you right away, but when we do partnership or even later on, when after we have done the capital gains, I'll take you through a bit of this. So let's say in very simple terms, there was a loss last year. That loss I've considered in carrying forward. Okay, so this point actually I'll take it at the end of the session when I've taken the loss carryover. Okay, so let's assume core business had a loss of 500 last year. This year had a profit of 700. And I'm supposed to knock off this loss and then pay tax only on the balance 200. If the tax is only on the balance 200, only this balance 200 will qualify for a deduction. So if any reason by which you take away the figure from your gross income, similarly, you will not calculate the QBI deduction line. And as I told you, there are two kind of things that we're going to take out from the picture. One, if you are having a passive income or something which is not linked to your core business activity, like your capital gains, losses, dividend income, and all of that. And the other is your personal thing. So if you're withdrawing money from your business, maybe because of health insurance premium or 50% of your self-employment taxes or retirement income, or if you're paying money, if you're getting money, and if you're an S corp member, then that is withdrawal, right? That's not salary. So you're not going to take it as a business income. Similarly, if you're a member or you're partner of a partnership firm and you're being given a guaranteed payment, even that would be outside the picture. Why? Because you're not getting this. You are the same person and you're just routing it differently. It is treated as a distribution of income. It is not regarded as your core business income. Okay. As I told you, if you are a partner or a shareholder of an S corp, But let's write your question in the chat panel, Anirban. I'll take it. Let me just finish this thought. That means if you're a partner or a shareholder at any point of time, in that case, you will reduce your self-employment taxes, health insurance premium, and any retirement plan. And on then you will calculate your QBI. Write the question in the chat panel. Okay. Look at this question, guys. Okay. Think and answer me. What is the call of the question? Ignoring the W2 limitation, what is the net amount of increase to taxable income from the partnership income? Okay, so that means whatever is the amount that you're earning as a partner, by what figure is the net figure that it will add to your tax life? So, total income, what proportion will increase by you conducting this business as a partnership? An individual taxpayer received a Schedule K1 partner's share of income, deductions, credits, etc. from a small partnership in which the partner owns a 50% interest. The QBI amount attributable to the partner is $70,000. This is only QBI and the taxpayer has no capital gains and other investments. Ignore all the limitations. Tell me if my share of partnership income is if my share of partnership income is 70,000, how much will it add to my taxable net taxable income will increase by how much by virtue of my being a partner in this firm? What's the answer for this? See, I earned 70, but out of 70, I'll already get a 20% deduction. That means my net earnings from this business and the net figure by which my taxable income will increase will be 56,000 only because I get the benefit of having the QBI deduction. So because of this QBI deduction benefit, the net amount by which my taxable income will increase will only be net of the QBI deduction. Okay. Now, how much is the income is dependent on what kind of business are you running. The first kind of business, as I told you, is something where the personal skill of either you or your employees make a lot of difference. In other words, the endorsements are important. So, if you are able to generate money from endorsements, compensation for use of one's likeness, appearance fees, and all of that, then I'm going to call it a specified trade of business. Now, some of them I want you to register in your mind, like health, like CPA, law, actuarial science, artist, athletic, financial services. These are the ones that have, they keep on adding new services here. So this is the latest entry. So remember health, CPA, accounting, lawyer, all of these are easy. But remember the financial services. Now, very strangely, they definitely pulled out two services from it. And if anybody can guess the reason, that person deserves a big round of applause. They pulled out two services and they said specifically these services are not SSTB. And those two services were architecture and engineering because they build something, right? An architecture and an engineer's cost can be clubbed with the cost of the product that they're building. They are already linked to the construction of a thing which is tangible. Hence, it's more on the building side. That's why we took it out from the SSTB. Now look at this question. Quickly tell me the answer. Tim owns Tim's Plumbing, which is a sole proprietorship. The motto that I run or Tim runs his plumbing services. He's a very skilled plumber and he has a great reputation. What do you think is the kind of business that he's into? Is it an SSTP or is it a QTP? What kind of business are we into? Can we have an answer, guys? What kind of business are they into? Is it purely service? The answer is no. It's a QTP business. So this is one kind of question that can be posed to you. What kind of business are we talking about? If it's SSTB, it's easy. If it is not SSTB, it becomes a QTP. Okay. Now comes the big question. How are you going to calculate your QBIT? Okay, as I told you, there are two parameters. You're going to talk about the kind of business that you're into and how much money are you earning. So the first question you've got to ask yourself is, what is a taxable income? Then you've got to ask yourself, are you a QTB or an SSTB? Okay. QTB is qualified business income. Barber will also be qualified trade in business. Barber, butcher, any kind of a home baker, everybody who, so remember, don't define a QTB, define an SSTB. Okay. Okay. Now there are four steps. Okay. And I'm going to, and every time if you apply this four-step concept, you will every time get the right answer. What are these concepts talking to you about? The first thing is, what is taxable income? Taxable income is, we know this, you take the AGI, below that you deduct either your standard deduction or itemized deduction, whichever is higher, or is left as a taxable income. The next question, are you an SSTB? If yes, you are an SSTB. If you're not an SSTB, you would be a QTB. Then I need to know whether a W-2 wage and property deduction is applicable for you. Now here, this is the time when I'm going to slowly think of you like a service industry. So I need to know how much wages are you paying. Okay, so I'm going to define this deduction for you, and then there's an overall limit. Okay, before that, let me first give you the idea how I want you to approach these questions. Okay, uh, one second. Let's open this. Okay. So see, if you are solving a question, I want you to follow this approach. Okay. What is the approach? This is the boundary. Okay. The first step I want you to figure out is, what is your taxable income? And I have booked it in a particular slab. So what is the slab? I've defined you a slab which differs for a single individual and a married filing jointly. For a single, and the rates differ from year to year, the rates differ. I think this year there are certain rates. I'll tell you what those are. Okay, I think it is 182, 100 this year, and plus 50,000. The upper limit becomes to 32,000, 232,100. And for a married filing jointly couple, I'll tell you what these figures are. But here it becomes $100,000. So this is exactly double of this. I think this is 364,200, and this is 464,200. So I have defined a slab rate for you. And now I want you to figure out how much is your taxable income and how do you categorize the society into three categories. So what are the three categories? The first category that I've defined is the below category. Are you below the threshold limits that I have defined? The next category is, are you above the threshold limits that I have defined? And the third category is, are you somewhere in between? So what I do, first thing, I understand what is the figure. So I take gross income, I reduce my adjustments, I get the AGI, I reduce standard deduction or itemized deduction, whichever is higher, and then I arrive at my figure that I have to put on this line chart. In the line chart, I draw the entire, everybody who's a business owner in the US who's not a C Corp, I will define you and put you into three categories. First category is below, second category is beyond, third category is in between. The next step that I'm going to ask you to do is, I'm going to ask you, are you, so this is step 2. Step 2 is, I'm going to ask you, are you an SSTB or a QTB? Okay, and why is it important? See, if you are really in a lower zone, then I don't bother whether you're a STB or a QTB, because you are earning so less that you don't have any risk of not paying my advocate money to you. So what I'll do, I'll forget you are a QTB or an SSTB. I will give you a full 20% deduction. Clear? So I go to the first step. I say, okay, how much is your taxable income? I put it on the tax slab. If you're below the first range, that means the phase out range, and let's say for practical purposes, I start with the married filing jointly couple. So if you have 3,64,200 and as a couple you're making less money than that, I will simply tell you that you're in the below range. I don't bother whether you're an SSTB or a QTB. What I'll do, I'll give you full deduction. I'm not interested in knowing what's the delta. Are you going to, because whatever you are, you're earning so less that it pose no threat. If you are above this particular threshold, that means you're earning a lot of money. Then if you're an SSTB, I give you zero deduction. No question asked. You are an SSTB, you're a purely service business. I'm not interested in knowing how much money you're making. You are not eligible for a deduction, period. What happens if you're in between or if you are above, but you are a qualified business income and you are a QTB business? If you're a QTB business, now I come to step 3. What does step 3 tell you? Step 3 is very clear. Step 3 says if you are an SSTB or if you're a QTB. So I will demarcate between the two. If you are a QTB, I have a different rule for you. If you are an SSTB, I have a different rule for you. Now, see, ideally, if you look at Becker, Becker has clearly told you, I will discuss this, I will discuss this, I will not discuss anything in between. As simple as that. I will discuss the first level, I will discuss the last level, I will ignore the middle level. Now, this is a little complicated. I will first take you a little ahead in concept, but I'm going to do this in the end if we have time. I'm going to concentrate on the below and the above category first. Okay. So what they did was this. They said that, see, if you are slowly entering the zone of having an only service criteria, I am going to pull out your the QBI deduction. On what basis? So there are two limitations I defined for you. The first limitation, so this I'll call it limitation 1. The first limitation was called the W2 wage and property limitation. Now, what did the W2 wage and property limitation said? I said, okay, see, whatever a deduction. Now, see, bother about the deduction. I gave you a full deduction. Now I'm trying to pull out that deduction, right? I'm going to reduce the amount. So it was 10,000, 100,000, 20%, 20,000. I'm going to reduce that 20,000. So what did I tell you? I say, see, find out what is the greater of the two figures. What is the greater of the two? What are the two figures? I will take the W2 wages, whatever wages that I have paid, take 50% of that wages. So if you are paying a lot of money through wages, or I will say you take 25%, that means 0.25 of your W2 wages. And with this, I add 0.25% of your UBIA. That means your unadjusted basis of acquired property immediately after acquisition. So the full form is unadjusted basis of property immediately of a qualified property. Hear me out, just 1 second. Immediately after acquisition. So what do you mean by that? I said, see, okay, so much of detailing is not there in any book and I might just leave it. But just understand what I'm doing is, are you paying a lot of wages? You take 50% of those wages, or I take 25% of that wages, and then whatever properties I have introduced into the business. So what is a qualified property? I say, see, whatever depreciable property you have put into the business, you forget about how much was the depreciation. You just take the original cost of that property and you multiply it by 2.5%. Now this, they will give it to you. If they ever give you this question, they will give you the UBIA. You just have to take that figure and take 2.5% of that figure. So what I say, okay, you take the greater of the two figures, W2 wages 50%, W2 wages 25%, plus 2.5% of unadjusted basis of a property immediately after acquisition. That means take the figure before considering all the depreciation. And then take the greater of the two figures. So how much deduction can you take? You can take, so here, if you are a QTB, what will I do? I will give you the full W2 wage limitation applies. What do you mean by that? It means I will take your, if you are below, I will give you full 20% deduction, no questions asked. And I'm not bothered, you're an SSTB, QTB, whatever. If you are above, if you're an SSTB, you get 0. If you're a QTB, I will limit your deduction to either 50% of wages or 25% of wages plus 2.5% of UBIA, whichever is high. So what I'll do is, that means what? I will first take 20% of QBI, or whichever was greater, W2 wage limitation. Whichever is lower, I'm going to take. Now, I know it's a little difficult to grasp everything right now. First, hear me out, because I can't take you through the question unless and until I've told you the basic rules. So, what step one? What is your taxable income? What is the figure just before taking the QBI deduction? I take the taxable income, I put it on the bar line, and I say, okay, below, in between, above. Then I ask you whether you're a QTB or an SSTB. If you are either a QTB or an SSTB below the threshold, I give you full deduction. If you're above the threshold, if you're SSTB, I completely give you zero deduction. I ignore you. And if you are a QTB, I ask you to figure out how much wages did you give. Either take 50% of wages or 25% of wages plus 2.5% of UBIA. Take whichever is higher. And then you compare it with 20% of QPI. Whichever is lower, you take that figure. First, I want you to drive this home. And there's one last step, which is called step 4. Okay, I have put all of this properly. I think after this, you will be able to understand that slide. What is step 4 telling you? So step 1, TI. Step 2, QTB or SSTB. Step 3, do W2 wage and property limitation apply. Step 4, there's something called a overall limitation. What is meant by overall limitation? Whatever deduction you are getting. So this, when you're calculating this, you're calculating it for one business. Let's say I'm running 5 businesses. I will add all the QBID for the businesses taken together. And from here, I'm going to take. So it's either total of QBID of all the businesses taken together, or I will take 20% of your LTCG. Okay, I'll tell you what it is. One second. Let me first see how they are taking it. See, it's either QBD of all the qualified businesses, or it is 20%, okay, of the taxpayers' taxable income, okay, in excess of the capital. Okay, so something like this. See, so I'll take 20% of all the taxable income that I'm getting just before the deduction minus your long-term capital gain. So basically what they're trying to tell you is this. Either you will take all the QBI deduction, or if you're earning a lot of money, you take the TI, take 20% of that TI. But from here, you remove the long-term capital gain. Why? Because long-term capital gain is taxed at separate rate already. I am charging LTCG at preferential rates. So I'm not going to take it through there. Okay, listen, I know this is a lot. Let's break it down into concepts. 4 steps. If I look at it, these are the 4 steps. What are the 4 steps? 4 steps says first take the taxable income. Second, find out is this an STB or a QTB. Third, find out if W2 wage and property limitation applies. When does it apply? Either when you're outside the zone or you are within the zone. If you are outside the zone and if you're an SSTB, you get no deduction. But if you are a QTB, then it's either the qualified business income deduction or the higher of the two figures, which is 50% of wages or 25% of wages plus 2.5% of your UBIA, whichever is greater. Calculate this for all the businesses separately, and then you add all of those businesses. The total QBI that you get is the lesser of either the QBID of all the businesses or 20% of your taxable income minus the net long-term capital gain. Okay, let me first take you through 2-3 small questions here so that you understand what kind of questions will be. Okay, I'm not taking you through all of this first. Take this question first, okay? See, Samantha is a home baker filing single and has the following. Taxable income before QBI of $50,000, net capital gains of 5,000, QBI of 40,000. You're supposed to calculate her QBI deduction. So we'll go slow. We'll take stepwise. So step 1, what is my QBI deduction? Okay, I think before that, I'll just show you the limits once. See, take this. This is like your master slide. If you can understand this slide, you've understood everything. See, we have taxable income. We put this in the parameters. So 180 to 100 in the between zone, in the above zone. Same with married filing jointly. If I'm a QTB or an SSTB in the below zone, I get full deduction irrespective of whatever be the situation. I get full deduction. I don't care whether you are a QTB or you are a SSTB. If I am in the above zone, then if I'm a QTB, I get a full W2 wage and property limitation deduction. But if I'm an SSTB, I get nothing. So right now, I just want you to decode the below and the above threshold. Later on, we will see if we can do the in-between threshold. Okay? So let's look at this question now. So I know my limits are what? Sorry. My limits are, uh, my limits are, if I am a single individual, then I know my limits are 120 to 100, 230 to 100. These are my limits. So I take the first question. So first step is what? My taxable income is in the below zone. Why? Because my taxable income is only $50,000. So if it is in the below zone, I know I don't care whether I'm an SSTB or I'm a QTB, I get full deduction. Step 2. Step 2 says, so what I'm in the below zone. Step 2. Am I a QTB or an SSTB? I'm a home baker. I'm not an SSTB. I become a QTB. Step 3. How much deduction I am going to get. So W2 wage and property limitation. Will it apply to me? The answer is no. Why? Because I'm not in the middle zone or in the beyond zone. So this limitation will not apply to me. So I'm not going to go to the third step, to the third one. I straight away go to the fourth deduction. So if I do this, ideally, what is my QBI deduction? It is 20% of my QBI. How much is it? 20% of how much is my QBI? QBI is $40,000. How much is it coming to? $8,000. But now I need to know what is my overall limit. So in the overall limit criteria, it should meet. Overall, what is the maximum amount that you can get as a deduction? You can get either a summation of QBID of all the businesses taken together, which in my example would be $8,000, or you would get 20% of what? You would get 20% of my all the businesses taxable income minus my net capital gains. So it is 20% of my taxable income, which is taxable income. Remember, this is not QBI. This is taxable income. 50,000 minus my capital gains, which is 5,000. So it becomes 0.2 of 45,000, which is 9,000. So what do we say? Cannot take a deduction which is higher than the overall limit of 20% of your taxable income. In other words, understand the logic. If my core business is generating a profit, but if my other non-business income is a loss, I will not let you take a higher deduction. So limit your deduction to your taxable income. So imagine the scenario when I'm having my core business. So if I'm earning 100, if my core business is 20, then I'm saying take 20% of 20, which is 4. Overall, cannot go beyond 20% of 100, which is 20. But when you're calculating 100, I'm saying take away LTCG because that you're already taxing at a preferential tax rates, right, of 20% maximum. So take LTCG away from it, from the balance, put 20%. So overall, whatever deduction you're taking should be below the 20% on your taxable income as a whole. So I know this is lower. That means my QBID is $8,000. Now ask me how many of you have a question. Please ask me now. How many of you like everything went above their head? If you anybody any question? Step 1. Are you a tax? What is your taxable income? Put it on the threshold. Below, in between, above. Step 2. QTB, SSTB. Either of the two, below range, either of the two, below, we'll do 2-3 more questions. Then we'll do a sim. I think this will get synchronized. It's not very difficult. Below everybody gets full deduction. So this is the example for the below range. Everybody gets full deduction. So how much is the deduction? 20% of QBI. Wage limitation does not apply. But overall limitation apply. Why? I don't want you to take a deduction which is more than 20% of your taxable income. So I don't want a scenario which is the reverse of what we just said. That you're earning a lot of money but you're having losses. Your taxable income has come down. See a scenario like this. Hey, everybody else is very quiet. I don't hear anything from you guys. Is it registering? See, let's say my taxable income is so much. Okay, let's say my taxable income is 100. But this 100 was after considering the core business income of how much? Of let's say 500. And then there were losses that I set off of 400. So my overall income is 100. I'm saying you cannot take 20% of a deduction of 100. Why? Because at the end of the day, I want you to limit your deduction to 20% of taxable income, which is 20. So if your business is more and other losses are pulling it down, I will restrict your deduction to 20% of your overall deduction. And from here, I take away the capital gains. Why? Because it is already being taxed at preferential rates. Now see, so much of concept will not be needed. Just take step 1, step 2, step 3, step 4. Step 1, taxable income, below, in between, above. Step 2, how much is your QTB, SSTB? If it is QTB, first range, full deduction. If it is SSTB, first range, full deduction. Beyond range, SSTB, no deduction. QTB, lower of either 50% of wages. What if there's a capital loss? We are going to deal the capital gains and losses separately. We are going to take it outside of the entire picture. Whatever
Okay.
is this figure, if it's a capital gain, capital loss, we'll take it outside the picture. But listen, right now, don't confuse. They will never give you a question like that here. The best part about CPA is if the topics are difficult, the questions are easy. In this sum, if they at all give you capital gains, they will mention it to you like this. Simple. If it's a capital gain or a capital loss, it will be separate. Is this clear? Okay, let's solve another question, guys. Okay, let's solve another question. You don't solve 5, 6 questions, this thing will just fit into your brain. See this. Eva is a lawyer, so be very careful about the profession that Eva is following. Filing as single. So I know the limits are 182, 100, 232, 100. So lawyer, single, taxable income is 50. That means below that limit. Net gain is 15, QBI is 40. Again, I take the same step. Step 1, what is my taxable income? $50,000 in the below threshold limit. Is it now step 2? Is it a QTB or an SSTB? It's a lawyer, personal name, tag, it's an SSTB. So step 3, does property wage limitation apply? Does W2 limitation apply? It's neither in the below between zone nor in the above zone. So the answer is no, it does not. Then I go to step 4. What is my overall limitation? So what is a general deduction that I will get till here? QBI D is 20% of my QBI. How much is my QBI? 40,000. So 40,000 into 20% gives you $8,000. What is my overall limitation? It's either 8,000 or it is 20% of my taxable income, which is 50,000 minus my long-term capital gain, my net capital gain, which is $5,000. So it is 20% of 45,000, oh, sorry, it's 15. Sorry, guys. Sorry, I took it from here. 15,000, right? So this is 35,000. So lower of the two, 7,000. So I take the lower of these two and I take 7,000 becomes my QBID deduction. Now understand what is happening. I am earning total 50, but out of this I am already taxing 15 at a lower tax rate. I take it away. I am left with $35,000 as my total income. I cannot give you a higher deduction than my total income, which is not taxed at a preferential rate. So in case if your QBID is higher than the 20% of your total income minus your capital gains, I'm going to restrict it till that figure. First, understand what's your taxable limit. Then understand whether you're an SSTB or a QTB. Then you know what are the rules. Below zone, both of them are same. Between zone and the above zone, W2 wage and property limitation applies. In the above zone, SSTB gets no deduction, but QTB get full deduction for W2 wages. What is the W2 wage limitation? Okay. Now let's do one thing. Let's do your SIP. If you do it with your hand, I think it will give you a lot of confidence. So I want you to open that Excel sheet. When you're doing the figures with your own hand, I'm pretty sure you will get a lot of confidence, guys. Okay. Let's do this question together. Everybody open the sim. So this is the question. Okay. Just do these two sims together with me. I think the entire concept will be driven home. Take this question. Brett and Shirley Cook. So we have time, guys. I want you to master these two sims. If you can do that, the smaller ones will become very simple. See, Brett and Shirley Cook, both age 40, file a joint return. Both of them are involved in several businesses and have contacted you inquiring about the Section 199A QBI deduction. They have provided information for their year one business income in the exhibit below. Brett and Shirley do not elect to aggregate any of their qualifying businesses. So you've got to treat every business as a separate business. Their only other income is Shirley's salary of 1,40,000 from her full-time job as an analyst. So they're running a business and one of them is also working with somebody and she's getting money from there. They will not be itemizing, so there's no question of an itemized deduction. There would be a question of standard deduction of 27,700. Using the information provided, you're supposed to calculate the taxable income before the QPI. So the first thing they're wanting you to do is get them the figure of gross income. If there are any adjustments, you remove it. And then from here, they've already told you that you have to deduct 27,700. So your first job is to calculate this figure. That's number one. Then for each business that has been given to you, you have to identify whether the business is a QTB or an SSTB or neither a QTB nor an SSTB. So three things. Step one, they are asking you to calculate the taxable income. Can you see step one? What is your taxable income? Step two, they have to calculate whether you are, so this is step two, whether you're supposed to be a QTB or an SSTB or neither. Neither typically means whether these provisions will not apply to you at all. Then step 3, you're supposed to calculate the QBI deduction for each business, each individual business, and then you're going to calculate the total of QBID. For this purpose, ignore any deduction for 1/2 of self-employment tax and use positive numbers. And in case if it is negative, you have to write. So if you're using positive numbers, no decimals, use whole numbers. And if the deduction is 0, don't leave a place blank. Please mention 0. So is the question clear to everybody? I have a couple and that couple is running a business. One of them is also working and drawing a salary and there's a standard deduction. Okay. Now, straight away go to your Excel sheet. So this is the business that they are running. So there's a limited partner. So there are 1, 2, 3, 4, 5, 6 businesses that they're all running together. Each of those businesses, there's a form of business that have been told to you, which is limited partnership, general partnership, S Corp, L Corp, limited partnership, sole proprietorship. They've told you the kind of business and they've told you whether the business is conducted in the US or not. Now, for each business, they've told you what is the share of business income that you're going to get from there. And they've told you what is the guaranteed payment or the salary that the partner is getting for these businesses. Then for each businesses, they have given you the wages paid and they have given you the UBI of the property. Is this clear? Is the call of the question clear? Everybody? Okay. Let's take the first question. How much is the taxable income? Okay. So how much is the taxable income? First, obviously, they're going to get their share of businesses income, right? So first is the money that they're making from your share. So first is how much money they have to pay tax on. So see, in all my sheets, guys, if it's a blue figure, it means that's a key in. It's an input figure. It's a green figure, it means it is linked to something. It will come. And if the figures are in black, it means that it's a formula. You don't have to touch that figure. So I got some figure which is coming from a flow through business income. Then one of the partners is going to give me. So there is, after that, this is also their income, right? But can you tell me, is this a core business income, guys? Share of guaranteed payment of a partner? It's not a core business income. Are you understanding now slowly? This is not core business. But this is still part of taxable income, right? This is not core business, but it is still part of taxable income. Okay, I still have to pay tax on it. But when I calculate QBI, I'll calculate it on this. I will not calculate it on this. Okay. 1 second, guys. So I think this is surely. I think this is red. Okay. Apart from this, you remember we had a salary. How much was the salary? Can you quickly tell me? Salary was 1,40,000. Everybody, is this clear? The salary was 140. That means now I know that my AGI before the standard deduction is 335. The standard deduction is how much? 27,700. That means your net taxable income is 3,07,300. Did everybody get this? When I calculate my taxable income, I will not care whether it's a business income, salary income, capital, everything I will put it together. So I get my AGI, I reduce the adjustments, none here. Then I arrive at AGI and then I get the standard deduction and I arrive at my taxable income. Now the first question, step 1, is it below, beyond or in between? For that salaried people, for the married filing jointly couple, the slab is between 364 200 to 464 200. Actually, this is just the double of 182 100, guys. Okay, I don't know if you can understand it. 182 100 ka double is 364 200, and then each one of them has a phase out of 50,000. So there's a total phase out of $100,000. So everybody, is this clear? So we are in the below threshold. We are very clear about it, right? So let's write the first thing here. I know that my step 1 is clear. We are in the below threshold limit. That means I don't bother if I'm a QTB or an SSTB. I will still get the full QBI deduction. Is this clear to everybody? Okay. Now, the next question. Okay, now here I will just freeze my pane, window pane. Okay, so 1 second. So now tell me, what kind of business are we talking about? So what kind of business is A? Can anybody tell me? I am into rental real estate. I have a limited partnership. So out of this, tell me which is the only one which is an SSTB. Can anybody tell me? Which is the only one which is an SSTB? So I know that apart from F, who's running a consultancy, I know apart from S, which is an SSTB, all the other businesses are QTB. Everybody agrees? But there is one business which is not operating in the US, right? If you are a business not operating in the US, you are not eligible for this deduction. That means for this business, I'm not going to bother giving you any deduction. So I'm not going to calculate your deduction for this business. Is this clear to everybody? Till now, is it clear? Step 1, what kind of taxable income are you having? Put it in the threshold, below, above, in between. Step 2, are you an SSTB or are you a QTB? Step 3, what is your taxable income? The taxable income is in the below zone. So if the taxable income is in the below zone, I know for sure that the W2 wage and property limitation will not apply to me. Hence, I have to ignore the data about wages and about UBID. So all of this data that you see here, I'm going to ignore all of this data. So what I'll do, I'll just calculate 20% of QBI. How much is my income? See, they've told me this is the income that I am making. Remember, this income is not the total income of the business. It is my share of that income. So how much is this? 20%. Is this clear? Okay. Is there any LTCG here? The answer is no. See, if there is no LTCG, don't bother. Because if there's no LTCG and if they're not giving you any other information. So, okay, listen. What is the overall limit here? They don't have any. So, my taxable income was how much? My taxable income was 3,07,300, right? So, I take this taxable deduction, I multiply it by 0.20. 61,460 is my upper limit. That is step 4. This is the amount that I'm getting here is only 34,000. Below, so full QBI deduction. So it is below the overall limit. Okay, let's just write it here. Overall limit is actually, sorry. This is the overall limit. So what is my QBID? My qualified business income deduction is the lower of the two, which is $34,000. Is this clear to everybody? Now this is easy. I get the full QBI deduction. I know what is my taxable income. Then I know SSTB was a QTB. So this is just for your, filling it up. This is how they give it to you. F, I will say neither. And F is an SSTB. How much deduction I'm going to get for each businesses? I just link it with my file here. So this is 3. Okay, now I have to link it individually. I have this. Okay, yeah, I forgot. It has to be, so this is not applicable and this becomes this. So my total deduction becomes 34 and my taxable income after QBI deduction becomes 273,300. Is this clear to everybody? Till now, anybody, any questions? Easy? Now is it slowly sinking in? At least the below threshold, is it clear to everybody? Is the below threshold clear to everybody? Now we are going to go to the above threshold, okay? Okay, this is the next question. Every data is same. The only data that changes is Shirley's salary. Okay? My question is, how is it going to affect you? The only data that is changing is one of the person's salary. Tell me, how does it impact my total calculation, what we did? Everything else is the same. Very good. That means my taxable income goes up, right? So in this question, the same question, sorry, I will call this Red and I will call her Shirley. Okay? In the same question, my flow through business remains the same. My salary that I'm getting remains the same. Now this is undergoing a change. How much is this becoming? 325,000. Now if this becomes 325, now we go in the above zone. That means if I take a 27,700 as a deduction, this goes in the above zone. Now, if I am in the above zone, then ideally full W2 wage and property limitation is applicable to me. What do you mean by full W2 wage and property limitation? It means, now see this, I will, what I'll do is instead of this, let me just copy this here. Okay. And let me call this. Okay. I'm just naming it separately. So this becomes easy for me to do. Okay. You'll understand the delta very well. So this salary is 325. The moment this becomes above, what is the threshold? Now I want you to remember this. The threshold was 464,200. It becomes above. So now this becomes above. Now if this becomes above, then the problem is that the wage limit. I will not let you take a deduction more than the amount of wages that you are paying. So what will I do? I will apply the property wage limitation to you now. So I know the segregation of the business will not change. But now this becomes above. And if this becomes above, then I know that the W2 wage and property limitation will apply to me. So now let's take the, I think I have done this here. I think I have to use this sheet only. Sorry. That's the reason I was taking this. Okay, okay, no problem. So we have this. So this is a QTB. I continue this for all except E, which will be neither. And this is SST. Taxable income is in the above zone, which will be applicable. Not now, end of the session. Wait, later. Okay. Now this limitation is applicable to me. So I'm going to apply this limitation now. Guys, 1 minute. Now. Okay. So ideally, what should have been my full deduction? This does not change, right? Ideally, my full deduction would have been 0.20 into the amount of income that I'm making, which is this. Right? This remains the same, right? My maximum deduction remains the same because it is irrespective of whether I'm in the above zone, below zone, or whichever zone I'm in. But now there would be my wage and property limitation, which will be applicable to me, which is how much? It's either 50% of my wages or it is 25% of my wages plus 2.5% of my unadjusted basis of acquired property. So what I'll take? I'll take 50% of the wages. How much is the wages? They've already given me the wages. I take 50% of my wages. Now see, one good thing, guys. Can anybody tell me what is a good thing? Good thing is this will be no. I will not get any deduction for my SSTB. Very good, Ketki. Very good. So this becomes 0. Is this clear? This becomes 0 because it's an SSTB. That's the reason if you say the total deduction that I calculated was only on the first 4 businesses. Okay? Or I will take 0.25% of my wages plus 0.025% of my UBIA. They will not ask you to find out the UBIA, guys, okay? They will not complicate it that much. They will give it to you in the question. Is this clear to everybody now? I am in the beyond threshold or the above threshold. SSTB will get no deduction, But a QTB will, the deduction will be limited to my W2 wages limitation. What does the limitation tell you? Take 50% of the wages or take 25% of the wages and add 2.5% of UBIA to it. Whichever is the figure, take the greater of the two figure. That means if you are into a business where you are investing a lot of property, take the high. And this, I think, is difficult to give you a visual today, but when we do capital gains, I will link it with the capital gains. Okay, then you will see why is this amount being considered here. Take the higher of the two figures. So higher of the two figures will differ. Be attentive here. Take the higher of the two figures. So this becomes 5 and this becomes again 5. What is the maximum deduction that you will take? See, you will take this row and you will take this row. And you take the lower of row 25 and row 32. Is this clear to you? So what am I saying is take the figure which is either W2 wages or, so I don't call it wages because there's a limitation rule. Take the greater of 50% of wages or 25% of wages plus 2.5% of UBIA. And now whatever is the figure, which is the higher figure, compare it with your QBID. Whatever is lower, remember, whatever is lower, you have to take that figure. So in the first case, this is lower. In the next case, again, this is lower. In the third case, again, this is lower. But in the fourth case, my QBID is lower. So my total deduction becomes 16,750. So now go and fill this up. See, this is done. I'm talking about my taxable income. The businesses, just fill it up. This is my QTB. Is it clear, guys? So this becomes still here. This is neither. And this becomes SSTB. Is everybody getting this? 477, 750. Is this clear, guys, now? Everybody, is this clear? Do you understand what is meant by W2 phase, W2 limitation? Everybody? Now see, I can give you 2-3 questions before. And now again, what's the last step? Don't forget the last step. The last step, they say take what? Take 20% of your TI. Here there is no LTCG. The reason why we are taking away the LTCG is because it is already taxed at a preferential rate. So this is 98,460. What I am thinking is 16,750 alone. So I know it is lower. So I go by that deduction. Now see, I'm taking you through 2 slides. Now tell me whether this makes sense. Now tell me whether this makes sense. See, now I'm reading this. Understand if this is making sense to you. First, I'll calculate my taxable income. Then I find out whether I'm a QTB or an SSTB. Then I calculate whether W2 wage and property limitation applies to me. And then I find out whether my QBID is within the taxable limit. I calculate the AGI just before the standard deduction, just before the QBI deduction. SSTB, if it is SSTB, great. If no, it becomes QTB. Then the W2 wage and property limited. That's the reason I say when applicable. See, understand, guys, that if W2 wages is higher, then I ignore it, right? If my W2 wage limitation is higher than my QBID, then I don't have to do anything about it. If it is lower, then I will have to give credence to it. So it's either 50% of my wages or 25% of my wages plus 2.5% of my UBID, whichever is higher. Just remember, whichever is higher. You take the higher figure, compare it with QBID, the lower one is taken as a deduction. Overall, I have to see whether the QBID is total of all the QBIDs of the qualifying businesses or take 20% of taxable income in excess of the net capital gain. Remember, I told you the qualified property is depreciable property used in business. When I take the net, now this portion here, I cannot explain you right now, the net capital gain. When we will do the capital gains next week, then I think this concept will become simple. Okay, the reason I'm taking it out is I'm already taxing it at preferential, lower preferential tax rates. Now, this is the master thing, guys. If you can understand this, you have understood the entire concept. So it's below, in between, it is above. These threshold limits you have to memorize. Even though in a sim they are going to give it to you, I think even in a MCQ they'll give it to you, but I will still suggest it's important memorize it. Remember, this is double of this, and isme you're adding 50,000 for a phase out, isme you're adding 100,000 for the phase out. Now see, understand this. This is very logical. If you are somewhere in between, that means I want to. So see what we are doing. We are saying if you are here, don't bother, take full. If you are here, SSTB, ignore. If you QTB, I'll give you full deduction. So basically what we are saying, now look at this question here, guys. I think if you can relate it to this Excel sheet, it will do you good. See, now look at this question, okay? See, what they're trying to tell you is, now what we have done, think. I took the full deduction and then I reduced it till 2 lakh 2,250. Why? Because we said, see, wage and property limitation is lower. It is pulling you down. So you have to bring it down. Because you were in the above threshold limit, I let you pull it down by what? I let you pull it down by the full figure. Do you realize this? I let you pull it down by the full figure. Why? Because that is why I said it's a full W2 wage and property limitation. Now, in this situation, my W2 wage and property limitation was higher. So I say, see, W2 wage limitation does not apply in this situation. So I'm not even going to consider it. Why? Because it is not applicable. The W2 limitation do not apply. So what do? We say, okay, wherever the amount is pulling you down, I should ideally give you the full one. But I'll give you the full thing if you are in the above bracket. If you are slowly nearing the above threshold, that means if you are somewhere in between, I will not pull out the entire thing. I will not let you take the entire thing down. What I will do, I will phase it out. How do I phase it out? Now, I'm just thinking aloud here, okay? Just for simplicity, assume that this figure was in that middle range. So it is 464. So let's say I pull it down by, let's say I make it 225. Now this comes in the middle figure. Yes or no, guys? Everybody. This comes in the middle figure now. It comes somewhere in between. It's neither 364 nor 464. It is somewhere in between. Now you apply the same old funda. How much up it is? How much up it is? My upper threshold was, lower threshold was 364, right? My lower threshold was 364. How much has it crossed 364? So I take the figure of 392 minus 364 200. Are you getting an idea? I'll divide it by what? I'll divide it by the threshold limit of $100,000. This was the tenure in which I extended it. Yes or no, everybody? Have you understood this? That means 28% I have crossed it. Have you understood this or not? I have crossed, I am about to be totally a purely service oriented industry. But right now I have eroded it only by 28%. So I will not let you pull out the entire figure. I will let you pull out only 28% of the deduction. Is this making sense, guys? Are you understanding what I'm saying? Okay, sorry. I have to freeze this figure. This figure was, so okay. That means I will not pull it down by the full figure. I will pull it down only by the phased in figure. How many people understood this? How many people understood this? This is case 2 between threshold for QTB. See, what I did was this. Since I am in the between range, I cannot pull out the entire amount. So I need to figure out how much. You remember I gave you that visual in my earlier sessions when I was teaching phase out. My phase out is between 364 200 and 464 200. This is that guy who's going to eat my phase outs. So this guy has crossed only 28%. So the full amount of 3000, when I'm going to bring it down, I cannot bring it down by the full figure. I will bring it because I will bring it down by the full figure only if I am in the bracket of income which is 464 200. So I'll bring it down by a proportionate figure. How do I calculate the proportionate figure? That figure is how much am I eaten into it. So 364 say how much we've crossed. We've crossed 28%. So only 28% of the deduction will be disallowed to me. So the balance I will still get. So instead of 750, I will reduce 3000 by only 211 and I will be getting this deduction. How many people understood this? How many people understood this? It's logical. Can you understand? This is really logical. Everybody understood this? Yes, no? Still exploring? Clear? Now this is the third. So if I look at it, see, if you look at it, we have done this, right? So if I look at cases, we have done case 1, we have done case 2, we have done case 3, we have done case 4. Now we did case 5. So what I'm doing, I'm in the between range. I am a QTB. I will take a phase in of W2 wage and property limitation. But I am applying it only if my limitation is lower. If I have to pull it down, I will phase it and then I will pull it down. Are you ready for the last one? That is definitely beyond the scope of your syllabus. But in SSTB, we want to make it further difficult for you. So what we are saying is, yes, there would be a phase in. Just like you do here, there would be a phase in. But how am I going to apply the phase in is a little difficult. What I will do is, see, same question here. Now, if you don't understand this, I will not ask you to whack your brain further. But if you can understand this, it's bonus. That means you're champion. That just tell yourself any question from here, I will do it if I've understood this. Now, in the last one, now see, if I've eaten 28%, that means I am left with 1 minus 28%. That means I am left with, I'm still entitled to 72%. How many people understood this? If I have eaten 28%, I'm still entitled to 78%. Now what I will do, I will calculate the QBI, the taxable limit, the wage limit, everything first. I will not give you on the full amount. I will give it to you only on 72%. That means the amount that I'm still eligible. So instead of taking the wages at, the income at 15, I will first reduce my income. Like how much? Now this income will become 15 into, can you see this? 72%. Okay, this is actually making it circular. Okay, so basically what I'll do is this. I don't want you to do this. I just want you to understand what they're asking you to do. First, I will calculate how much I have eaten. That means I'll be left with how much is still eligible for me. I will first put my QBI, my wages, and my UBI. All I will pull down. Not to full 100%, but only to the percentage that I am entitled to. I will first reduce it. Then I will calculate taxable income into 20%. That means QBI into 20%. And then I will apply the same concepts of phasing of W2 wages to it. How many people understood? See, there were 3 parameters, right? My QBI, my W2, my UBID. I will first reduce my QBI by 75% to 78%. I'll reduce it to whatever is it into 78%. Wages, whatever into 78%. UBID, whatever into 78%. I'll bring all of them down and then I will continue the same things. Then I will see, okay, what is my W2 wage limitation? If it is lower, Then again, I will have to repeat the step of phasing it in. So see, this is what the slide says. First, reduce the QBI. First, reduce the QBI W2 wages and the qualified property amounts to what? To that 78% figure, which is the amount that I'm still entitled to. And then apply the same concept of the QTB to it. Have you understood, guys? I mean, this is a really challenging topic and I understand it. I have really made an attempt that you understand the below and the above category really well. I think I have done this also fairly well. For this, what I'll do is, for this question, I will give you the solutions. Now, this is like a comprehensive concept. Everything that we have done, if you can follow this, it can be good. But to understand this slide, you will have to do these kind of questions. The problem is Becker has no MCQ in this area. UWorld still has a little bit more, but UWorld has no sim in this area. Okay. So what you have to do is the approach that I am suggesting, do that. Take one Excel sheet, tinker with the figures. If you are able to do that, you are sorted. Okay. So this is one slide. I'll give it to you. But this comes after you've done. So I want you guys to go back home and redo that Excel sheet once more. Okay. And there are certain questions that I have given. For few, I have discussed. For others, I'll give you the solution so that you can do this on your own. Now tell me, anybody, any questions? I'll give you the solution for all of these. Okay. For the others, I have extended it. So in between also, I'll give you two small questions whereby you should be able to understand the basic concept. Okay. This and the other one is completely theory, and I think you should be able to understand. It's not very difficult. I've given you a self-explanatory question also here. I have already done two sims with you. For one sim, I want you to do this on your own. This is not a difficult sim, and the concept of QBID is applicable at a very, very nascent level. But I want you to understand how the figures will flow through.